We are witnessing a historic pivot in global finance. For the first time in decades, a fundamental ranking has flipped. Gold has overtaken US Treasuries as a leading reserve asset. Central banks now hold roughly $4 trillion in gold, compared to $3.9 trillion in treasuries. This is not just a prediction, it is positioning. Countries are moving away from interest-bearing debt and back toward tangible, neutral assets. It is the ultimate form of risk management. In a world of frozen assets and rising debt, gold offers optionality that the dollar-based system no longer guarantees. When central banks shift their trust, every business feels the ripples. Pricing, cost of capital, and long-term stability are all being recalibrated. The system isn't just changing, it's being reweighted. The advantage goes to those who understand the shift early. The global financial landscape is undergoing a historic shift as the era of undisputed US dollar dominance faces its greatest challenge yet. De-dollarization is no longer just a theoretical risk, it is an active strategy being adopted by major economies across the globe. Weakening demand for the greenback is driven by a combination of geopolitical tensions and the weaponization of financial sanctions. The BRICS nations are at the forefront, exploring new settlement systems to bypass the SWIFT network and reduce their reliance on American debt. Central banks are diversifying their reserves at a record pace, pivoting toward gold and local currencies to safeguard their sovereign wealth. For the United States, this shift could mean higher borrowing costs and persistent inflation as the exorbitant privilege of the dollar begins to fade. Geopolitically, this marks a transition toward a multipolar world where economic power is more evenly distributed across continents. While the dollar won't vanish overnight, the trend is clear. The architecture of global finance is being rebuilt for a new century. Staying ahead of these shifts is crucial. We will continue to track this evolving global story. The US national debt is reaching levels that are starting to rattle global markets. It's no longer just a fiscal debate. It's a question of systemic sustainability. As interest payments soar, the Treasury is navigating a narrowing path. Market sentiment is shifting from cautious to genuinely concerned. To manage this, the Treasury has initiated buybacks, a tool to inject liquidity and stabilize the market. But many wonder if this is a solution or a stall tactic. Former Treasury Secretary Henry Paulson recently issued a break the glass warning, signaling that we are approaching a moment of necessary drastic intervention. His warning underscores a fundamental truth. Without restored fiscal discipline, the tools that saved us in the past may not be enough for the future. As the debt spiral continues, all eyes are on Washington to see if they will act before the glass is truly broken. This remains our primary focus. The global financial landscape is undergoing a tectonic shift that could redefine international trade. China's push for RMB settlement is no longer just a theory. It is actively reshaping how nations conduct business. Platforms like CIOPS and the M-Bridge project are building alternative rails, creating a parallel system for international payments. These innovations allow participating countries to bypass traditional dollar-centric networks and mitigate sanctions risk. For the BRICS nations, these payment rails represent a significant leap toward total financial sovereignty. As these technologies mature, the very foundations of global economic power are being permanently rewritten. The European economy faces a historic test. Germany's industrial sector, once the heart of the continent, is now showing significant strain. Rising energy costs and a cooling global market have pushed manufacturing to record lows, raising questions about future competitiveness. At the heart is a dependence on China. A partnership that once drove growth now presents a complex strategic risk for the continent. The EU's reliance on Beijing is being re-evaluated through a lens of geopolitical vulnerability and national security for the Union. Brussels calls for de-risking, but decoupling is difficult given the scale of existing industrial and economic integration today. Leaders weigh the long-term cost of independence against the immediate pragmatic necessity of global trade and essential partnership. Diversification is the mandate, but rebuilding resilience requires massive, sustained investment in local infrastructure for the future. As the map is redrawn, the EU must decide if it can maintain its industrial edge alone without primary trade partners. It is a delicate balance between economic pragmatism and self-reliance. Thank you for watching this report for the Pacific Brief. The economic friction between the US and China has evolved into a full-scale warfare across critical sectors. From energy and technology to agriculture, the stakes have never been higher for global markets. Sanctions on Iranian oil have created a complex web of shadow fleets and clandestine refineries. China remains a primary destination, challenging Western attempts to isolate Tehran's energy exports. In the digital realm, the battle for AI supremacy hinges on the availability of high-end semiconductors. US export controls aim to slow China's progress, while Beijing pours billions into domestic manufacturing. Rare earth elements are the lifeblood of the green transition, and China's dominance provides significant leverage. Agriculture has also become a front line, with food security tied directly to geopolitical posturing. As both nations decouple, the question remains, can these giants coexist, or is a total economic schism inevitable? The global economy breathes through a few narrow arteries. When these choke points tighten, the shockwaves are felt worldwide. The Strait of Hormuz is the world's vital oil transit point, where 20% of global petroleum and liquefied natural gas flows daily. Any disruption here directly threatens global energy security, causing immediate and severe inflationary pressure on the global market. Further east, the Strait of Malacca is the primary gateway and the busiest shipping lane on the planet. Over 94,000 vessels pass through this narrow corridor annually, carrying raw commodities and essential consumer goods. These lanes are also critical for fertilizers and helium, both vital for global agriculture and advanced high-tech manufacturing. The fragility of these routes means a single geopolitical event can trigger a cascading crisis in global production. As tensions rise, the strategic value of securing these waterways has never been higher for global powers. Securing these passages is a fundamental pillar of economic stability in an increasingly volatile and interconnected world. Stay tuned for more insights on the Pacific Brief as we navigate the future of global trade together. Thank you for watching. China is currently undergoing a massive and rapid energy transformation. To reach carbon neutrality by 2060, Beijing is executing a sophisticated, multi-pronged strategy. Solar is first. China controls 80% of global manufacturing, scaling its own capacity while cutting worldwide costs. By leading the supply chain, China secures its role as the top green tech provider for decades. Nuclear is next. With dozens of reactors under construction, China will soon lead the world in capacity. Small modular reactors, like Linglong 1, offer safe, flexible power for industry and remote hubs. Then there's fusion. China is investing billions into the artificial sun to achieve long-term clean energy. This isn't just about climate, it's about energy security and reducing reliance on imported fossil fuels. As these mature, China becomes the world's leading exporter of next-gen energy infrastructure. This transition will define the century. From solar farms to fusion labs, power is being rewritten in China. The tech industry is at a critical crossroads. Today, we're analysing the wave of AI-driven layoffs currently restructuring the global labour market. As companies pivot their resources toward artificial intelligence, the demand for traditional software roles is shifting more rapidly than many anticipated. Major industry players are shedding thousands of positions, citing a need for lean operations and a singular focus on generative AI development. But this isn't just a cost-cutting measure. It represents a fundamental transformation in the very architecture of how tech products are built and maintained. AI-driven automation is now capable of handling complex tasks that previously required entire teams of junior engineers to execute. This restructuring is creating a new hierarchy where deep AI expertise has become the primary currency for survival in the tech sector. The human cost of this transition is significant, yet the industry maintains that this evolution is essential to remain competitive in the age of intelligence. Labour advocates are watching closely, questioning if the promise of increased productivity truly outweighs the widespread displacement of workers. As tech labour continues to evolve, the balance between human talent and AI integration remains the industry's most complex challenge. Silver is no longer just a precious metal for investors. It's becoming the essential backbone of the global green energy transition. As China aggressively accelerates its solar manufacturing capacity, the demand for silver in photovoltaic cells has reached record highs. This shift is a core component of Beijing's broader industrial strategy to achieve global renewable energy dominance. New technologies like TOPCon and HJT cells require significantly more silver per watt, tightening the global supply chain. China now controls the vast majority of solar panel production, effectively transforming silver into a strategic industrial metal. Industrial policy is now driving metal demand more than traditional investment cycles, creating a fundamental shift in the market. The massive scale of China's commitment means the silver market must adapt to a permanent, high-volume industrial consumer. This creates a unique intersection of global climate goals, industrial competition, and raw material scarcity. Success in this landscape requires understanding both the technology of the panels and the strategy behind the production. As industrial strategy continues to evolve, silver will remain at the heart of the world's most critical manufacturing race. Thank you for watching. Global markets are at a crossroads as we witness one of the largest wealth transfers in history. Trillions are shifting between generations, fundamentally altering the landscape of asset ownership as we know it. But it's not just about who owns what. It's about the very nature of the assets being transferred today. We categorize assets into two camps. First, printable assets. Think fiat currencies and government bonds. These are susceptible to inflationary pressures and central bank interventions, which can often dilute their long-term value. Then there are unprintable assets. These are finite, scarce resources that simply cannot be created at will. Gold, land, and digital scarcity. These assets act as a hedge against the devaluation of printable alternatives. As the transfer continues, the pivot toward unprintable assets is becoming a defining strategy for wealth preservation. Understanding this fundamental distinction is crucial for navigating the global economic shifts that lie just ahead. This is a critical moment for global finance. Stay focused on the value that truly lasts. China is making a bold play for the Arctic. Beijing is quietly positioning itself as a near-Arctic state while the world looks elsewhere. This isn't just about shipping routes. It's a strategic move that could reshape global power dynamics in the high north. The Polar Silk Road is the centerpiece, linking Asia to Europe through the melting Arctic ice. But behind economic talk lies a growing military footprint. Dual-use infrastructure is being built across the region. The threat few discuss is the erosion of Arctic sovereignty and a new theatre for global conflict. Competition for rare minerals and energy is intensifying as the ice recedes, drawing major powers into a new scramble. NATO and Arctic nations are taking notice, but is it already too late to balance the scales? This permanent presence allows for constant surveillance in a strategically vital and sensitive region. As the ice thins, the region is becoming a new arena for scientific and strategic dominance. The Arctic is now a central front in global strategy. I'm Ingrid Nelson. Stay informed on the shifts defining our century. The global financial landscape is undergoing a historic shift as the era of undisputed US dollar dominance faces its greatest challenge yet. De-dollarization is no longer just a theoretical risk. It is an active strategy being adopted by major economies across the globe. Weakening demand for the greenback is driven by a combination of geopolitical tensions and the weaponization of financial sanctions. The BRICS nations are at the forefront, exploring new settlement systems to bypass the SWIFT network and reduce their reliance on American debt. Central banks are diversifying their reserves at a record pace, pivoting toward gold and local currencies to safeguard their sovereign wealth. For the United States, this shift could mean higher borrowing costs and persistent inflation as the exorbitant privilege of the dollar begins to fade. Geopolitically, this marks a transition toward a multipolar world where economic power is more evenly distributed across continents. While the dollar won't vanish overnight, the trend is clear. The architecture of global finance is being rebuilt for a new century. Staying ahead of these shifts is crucial. We will continue to track this evolving global story. The Pacific Brief will drop new financial and geopolitical analysis 3 times weekly. Stay tuned and thank you for watching the Pacific Brief. Have a wonderful day. This is Ingrid Nelson signing off.